where do you think this belief comes from that subjectivity equals randomness or not good, and objectivity and mechanical equals better? Where is that coming from?
I think it's rooted just in our beliefs of how we live our life. You know, the same way, you know, you don't cross the road without looking. You wouldn't go, right, 9 times out of 10, I'll be fine. You would always look. So we seek certainty in everything. We want absolutes in everything. And I get it, but that's the animal instinct mind. It's very difficult to shy away from that. Like the trader brain, you don't arrive with a trader brain, you have to create one. So this idea of not working on psychology doesn't make sense, because the top traders in the industry, right, even when you look at people like Richard Dennis, right, these top traders that have even had really poor strike rates but have made it work. There's actually a story about Richard Dennis, who he was trying to teach people his system. He had something like a 10% strike rate, but he couldn't teach it. No one could do it. And it's you have to do a bit of digging and a bit of research. And he was a phenomenal trader, right? Made millions and millions. However, wasn't able to help someone replicate it. Why? Because most people couldn't walk around with a 10% strike rate and perform. Because you'd be all over the place. You'd have to be comfortable in deep drawdown all the time. And then your winners would have to run so big, and you'd have to be aggressive at the right times to scale in and be comfortable with that. And most people are not. But going back to your question, to keep it brief, is I think we're conditioned at every level to just seek certainty because we want to be safe. And having any element of discretion makes us feel unsafe. So we have to go to what is 100%. I want something, I want to know every variable, but the market is random. Yeah. So seeking that, I think, is actually not healthy in the first place. Be as mechanical as possible, but you can allow for 1 or 2% of interpretation, and you actually gain an edge there.
Yeah, I forgot the name of the book. It's something Zen. Maybe you know better. It's a psychology one on trading. I read it a while ago, and he said that every trading emotion can be boiled down to you want to avoid an unfavorable outcome. Whether it's I don't want to blow the account or whatever. It's avoiding an unfavorable outcome, but everybody enters a trade thinking they're going to win. Otherwise, you wouldn't enter it.
Of course.
If you thought you're going to lose, you just sit it out. So there's that complete opposite end of the spectrum where undesirable outcome, but you're feeling more certain. And that's the space where psychology and problems arise. I'm starting to understand now your approach to the market is more mechanical for your entries and the strategy and the confluences, but you leave subjectivity open in your profit management.
Yes.
Is that so? Okay, so this is where I was in my trading for majority of my career, which was the first 5 years. And I felt fine. Like I thought this is the correct approach, because let's say I'm holding a trade. I thought, let me make it to a structural low before I take a good volume off, because it's bearish. Let me make a new lower low. Things like this. And it was always price action based profit taking. And it was working. And there's only until I really reflected on my data, and I've spoken about this before, where I realized that when I have my full winning trade, it will follow my price action approach, where I've hit my final TPs because everything did what I wanted to do. But that's not the normal case. It's not like 100% of the time. It's more of an outlier. It's maybe 10, 20% of the time it reaches my final TP. So losses aside, it was more how much of my winners, how far do they go? So there's certain trades that maybe only go 10 pips in profit. That was an outlier. There's certain trades that went all the way to TP and beyond. That was an outlier. And it was a bell curve where the majority was in the middle. And when I reflected on my data, I realized, well, if I'm taking a price action based profit taking approach, I'm optimizing for that extreme, which is the ones that go to final TP and beyond. And that is out of my control. But if I look at the data, that is more controlled. And I realize instead of optimizing for an individual trade, which is an individual trade's optimization is holding full volume to the final TP, 100% volume at that final TP. But what about all the times it doesn't reach that? That is what you're trying to avoid. So when I started to think, okay, well, I'm not optimizing for an individual trade, because if I was, the best thing to do is 100% volume all the way. But you don't. You take partials along the way, because there's situations where it doesn't do that. So then you factor in zones of reversal, and that's where you start to partial along the way. So you're already starting to look at that bell curve. I was like, okay, well, this might not go all the way. So there's a chance it goes half the way. So let me take a profit here. So I thought, let me scrap all of that and let me just make it mechanical in my profit taking also, where I just optimize for my portfolio and the data I have, which was the bell curve is like this. Let me take most of my profit in the middle at the peak of the bell curve. So I know that from a smart money trader, which I'm not necessarily, but higher risk reward is very achievable in this day and age. The problem becomes the win rates. But high risk reward, most people can do. It's just how many losses you have and give it all back. Yes. So I thought, instead of me trying to hold these mammoth trades of 1 to 50, 1 to 30, whatever, and that's a rarer occasion, let me optimize, because it's harder to know what's going to happen at the end of the month. There's too many things that can happen along the way. But it's a lot easier to know what's going to happen during a London session or by the end of the day. It's a lot easier to understand that direction. So I thought, if I'm not optimizing for a final TP, which there's too many variables along the way on a higher time frame, let me optimize for a lower risk reward, and let me optimize for the day or the session. So then I started to take an approach of, let me cap every single trade at, let's say, a 1 to 10, and I have a discretionary approach. So mine became at a 1 to 3 risk reward, 50% volume, no matter what, and 100% volume at a 1 to 10. Even if it went further, I knew it was the outlier on my bell curve. And when I did that, I didn't have to change my win rate. I didn't have to change my strategy. I didn't have to change my entry models. Didn't really have to modify my psychology. I just had to optimize my profit taking, and my profitability adjusted off the back of that decision. Which is why it's interesting to me that you're saying still you have an approach of, you want to have discretion in your profit taking. So talk me through your individual journey as I've had that reflection moment. What did you go through arriving to the decisions you have?
That's very interesting that you approach that model that way. So these are, again, these outliers, these anomalies that happen, you don't really care about them so much, right? Because you've maximized your curve by hitting the 10 to 1s in those scenarios. I'm just creating something at the moment that I've been working for a year. Essentially, I've revamped all of my content, and I'll explain why that links to that, because I believe I've become a better teacher, a better communicator over the years. I think 5 years ago, I wasn't communicating how I trade effectively, as I didn't come into trading to be a teacher. I was never a teacher. I was just a trader that happened to start helping people organically. I didn't create a big marketing campaign to launch a course. You know, I had 1,200 followers on IG. It was just people was asking me, and I was helping them, and it organically grew into this project to Falcon. But I realized there's a lot of gaps. And before, from an ego point of view, I would take it personally, where people would say, no, you trade too much discretion. I'd say, no, I don't, because in my head, it's a very mechanical thought process. It's just I wasn't communicating that effectively. So there was too much discretion displayed, whether it be execution or management. So I've reshaped that. But upon reflection of looking at similar data, I've added in a new model, which is actually a mechanical based hedge for these trades for management. So there's two ways that I can approach it. I don't recommend it for beginners, but for more of our funded traders, they know what they're doing. And it's more situational to what's happening in the current times. Like, for example, CPI, that never used to be as volatile as what it was, the same way NFP for years
used to be a lot more.
was and then wasn't, you know. So you have to be, you know, agile enough to think that the market is never just the same. And I've been doing it 15 years, so I've seen a lot of different things, recessions, etc. And I've realized the smartest thing over the last year of data, if I would have had more of a mechanical approach to my management in certain areas on the intradays, I would have actually walked away with more profit. And the anomalies that run for like your 16%, it doesn't matter, right? But I've done it with a Fibonacci tool just to keep it very simple. But I'm looking forward to, because that's coming out with our mechanics at the moment. And I think it's going to be a big catalyst for those that are using too much discretion in management and essentially leaving too much profit on the table and not really knowing how to deal with that scenario.